Ladies and gentlemen, welcome to Kohler Group's expansion into China webinar series. This is part 6 of 10 webinar sessions. The title of today's presentation is Accounting and Tax System in China. First of all, a short introduction of our topic today. In order to run your China business in the most cost-efficient manner, it is necessary for finance officers to understand all the potential relevant tax costs that will be incurred in China before making an investment decision and to create the necessary budgets to operate optimally in the market. In this webinar, we will focus on providing introductory information to finance officers and their teams on the general accounting system in China. And we will give you basic tips on how to read Chinese financial management reports. In addition, we will provide insight into the main taxes incurred and how they are calculated and declared in order to be able to create the necessary budgets and remain compliant. Lastly, we will be looking at the latest tax incentives offered to foreign investors. I'm very pleased to have our director at Kohler Group, Mrs. Cristina Kohler-Coluccia, as our speaker today. Before we begin today's presentation, allow me to settle some administrative matters. I would like to make sure that the sound system is working perfectly. If you could hear the introduction and you can hear me clearly, please click the hand button in the control panel, which will give me the signal that we have no technical issues. If you're using a computer and mic and speaker system and you have trouble listening, please note that there is the option to dial in via the telephone by simply clicking this in the audio section of the control panel. Please note that we're recording today's webinar session and the presentation together with the recording will be distributed to the registrants by the end of the day. Ladies and gentlemen, as we do in all our webinar sessions, we do encourage all the attendees to submit their questions as well as comments into the question section of the control panel. The presentation today will last approximately 45 minutes, after which we aim to have a 15 to 20 minutes Q&A session. Please don't be shy in inserting your questions or sharing experiences. I will now pass the microphone to Cristina, who will introduce Kohler Group and herself, and will then begin with today's presentation.
Barbara, thank you very much for the introduction. To all those that are new to Kohler Group and our webinar series, allow me to just briefly introduce who we are. Kohler Group, a CSC company, provides a wide range of market entry consulting, incorporation, tax, accounting, and human resource services to companies that are looking to enter and operate within the Asian market, primarily in 3 jurisdictions, Hong Kong, Singapore, and China. Our firm was established in 1979, and since then we've grown to having just over 120 professionals located throughout our 10 offices, 8 offices in China, Hong Kong, as well as in Singapore. Our main objective is to help foreign investors create an optimized structure, both on a legal perspective as well as on a tax perspective in terms of entering the Asian market. And not only that, but then also looking in the long term in terms of expansion within the market and potentially further expansion into Southeast Asia. One of our unique advantages is that we do speak over 10 languages internally and are able to communicate with our clients in their mother tongue. Just a little bit about myself as your speaker today. My name is Cristina Kohler-Coluccia. I'm a director at Kohler Group. I've been with the firm since 2003 when I opened our first office in China, primarily in Shanghai, and have expanded our operations to having 8 offices in China. I've been working very closely with startups, small, medium-sized companies, as well as multinationals in terms of their entry into China, their expansion within China, and unfortunately, in some cases, their liquidation from China. I'm also co-author of our monthly magazine, ChinaInvest.biz, which highlights all the latest trends and regulations that are occurring in the Asian market, not only in China. So without further ado, I would like to start off today's presentation and look primarily or initially at the Chinese accounting standards. And I've listed here a series of 5 points which I find quite critical in terms of a CFO developing his financial system in China. The first is understanding PRC GAAP and how it differs to the rest of the world. It's very difficult for me at this point to give concrete examples of differences because it really depends on what type of system you're using in your own home jurisdiction, whether it's IFRS, in Germany there's a system called DATEV, etc. But there are certainly differences, and you need to be aware of how bookings are done in China in terms of PRC GAAP and how things can then be created in terms of consolidated reporting for the home jurisdiction and the home office. Monthly financial management reports are a must in China, and the primary reason behind that is because there are tax declarations which have to occur on a monthly basis, primarily with the turnover taxes, value-added tax and business tax. As such, these management reports must be completed at a certain deadline in order to not surpass the deadline of the tax declarations. Year-end financial management reports are also critical, primarily because nearly all companies in China must follow the calendar year as their fiscal year, so therefore January to December. Exceptions can be made and applications can be made to the tax bureaus in order to change that fiscal year, but usually this is really for the top multinational companies that have a series of entities that are located in China. As the year-end management reports must be completed by the end of December, primarily again because of tax declarations that are due by mid-January, there's a very tight time frame to complete all annual compliance procedures in terms of year-end audit reports and year-end tax filings. Both the monthly management reports and the year-end management reports, one of the key tips that I can offer you in order to be able to match the necessary deadlines is really to do monthly reviews. When a management report is issued, review it to see whether adjustments have to be made, and if there are adjustments which have to be made, to do them immediately at that time. Looking at a year-end report and trying to evaluate month to month what needs to be adjusted, that's extremely time-consuming. And when there are deadlines that have to be made in terms of tax filings, etc., you want to make sure that the figures at the year-end are accurate and not estimates. Do you need to have two sets of accounts? Now, most foreign investors in China do have two sets of accounts, one primarily based on the PRC GAAP system, whereby the tax declarations are based on those financial management reports, and you'll have a set of accounts based on consolidated group reporting requirements, whether that's IFRS related or any other type of system. Can you find good, reliable English-speaking accountants in China? Well, there are many options available to you in terms of how you want to develop your financial system in the Chinese market. If you are a startup and you've just entered the market and you're looking to see how you can create the system without knowing very much about it, the first option available to you is to outsource everything, meaning you're outsourcing to a service provider that already has an accounting software system that has been approved by the tax bureaus. The system is already bilingual, it's already been utilized, which means that you're not running into any difficulties in terms of learning the system, first of all, purchasing the software system and learning how to utilize the software system. In addition to all that, by outsourcing, you already have qualified CPAs and accountants on staff in all levels, whether it's from financial managers all the way down to just senior accountants, junior accountants, or even cashiers who are managing your entity and helping to develop a system or workflow on a month-to-month basis that fits into your business model and into your finance team's way of doing things. Can you find good English-speaking accountants in China? In the Tier 1 cities, absolutely. You can find excellent English-speaking accountants. The issue for me is not really on language capabilities. You do need to be able to communicate, but in any case, finance people have a certain way of communicating, as do IT people. The issue is just having an accountant that has the experience managing and running a foreign investment company, whether it's an LLC or a representative office. Having had experience, whether working for logistics firms, trading companies, manufacturing companies, they know how to deal with VAT issues in terms of VAT exemptions, VAT refunds. They know how to speak to the tax officers, how to negotiate with the tax officers. All of this comes with experience for accountants. And honestly, it's like that anywhere in the world. As such, if you're trying to find a good accountant that has experience, you're not looking at new graduates, who obviously are much cheaper to hire than those that have 10, 15 year or 20 years of experience. You need to evaluate when you're starting up your business or even when you're 2 years or 3 years down the line in your business, how qualified of an individual do you need in terms of experience and background? Language should really be a secondary priority to that. You really just want to look at what do they know, how can they manage your business, and in many cases what people forget is, can your accountant advise you? Can they advise you on your cash flow? Can they advise you on tax optimization? Outsourced providers, they provide this service together within their packages. But when you start hiring internally, you want to make sure that you get that type of service from the accountant that you're hiring. So in general, looking at the Chinese accounting standards, understand what is PRC GAAP, understand if you're going to purchase your own accounting software system or whether you're going to utilize an outsourced provider's accounting software system. Understand that all documentation must be submitted in Chinese language, therefore having a second set of reports or even a third set of reports where everything is done in English is invaluable to you. One of the biggest mistakes that I've seen from many clients is just not reading the management reports, not paying attention to the figures, not focusing on a month-to-month basis as to the progress and the status of the company. One of the biggest issues that Kohler Group sees with many of its clients is a lack of ignorance, not asking questions in terms of the PRC GAAP reports so that they understand how bookings need to be done. They understand how internal workflows have to be improved in order to make sure that the reports that are being generated really fit to what is needed. Now, moving on from the Chinese accounting standards, the next question that is important to understand is, who are the tax authorities in China? How do the tax authorities make decisions? What are their objectives and goals? How can you negotiate with them? And how does the system work with that? That's really a key point that you need to realize. And I've listed here a quote that I think is quite interesting. If you know the enemy and you know yourself, you need not fear the result of 100 battles. Let's rephrase that. If you know the tax bureau and you know your objectives and your goals, you need not fear negotiating with the tax bureau to obtain the objectives and goals that you want. The tax bureau is not necessarily your enemy. You may think that when you're going into the Chinese market, but if you have open transparency and you have discussions with the tax bureau about what your objectives are, what you're planning on doing, what are your workflows, what types of transactions are you dealing in, then they are already a step forward in terms of optimizing your structure. Obviously, the goal of any tax authority is obtaining tax revenue. It's common sense. So they are going to try and make your life difficult. They are going to analyze any applications that you're doing. They're going to look that you match all the criteria that you're supposed to match, because ultimately they do want you to pay taxes, right? That's how they're sustaining themselves. Now, let's understand how the tax authorities work in China. If you establish an entity in Shanghai, depending on where your registered office address is, you're going to be working with the tax bureau in that district. So let's use the example of Jing'an district. You've established your registered office address in Jing'an district. You are obligated to then register with the tax bureau in Jing'an district. There is a competition in Shanghai, as in most other cities, as to which tax bureau in which district earns the highest revenue levels. And that's their main objective. So what happens is you are then appointed a tax officer. Within 30 days of issuance of your tax certificate, you have to meet with this tax officer to introduce the company, introduce the transactions that are going to be flowing through this company. And my biggest recommendation, although it's very rarely feasible and possible, is we would love to have the CFO from the home jurisdiction come with us, only to get a feeling of how old school the tax bureau looks like and how old school the negotiations are. It's not online applications and it's real negotiations that have to occur. You have to go to the tax bureau, you have to pick a number, you have to wait in line until your tax officer is readily available to meet with you and have these primary discussions. If the finance teams abroad would understand the difficulties one has because of how old school the system is and how old school these negotiations are, you would get a much better understanding for the long term of your business to understand how things are developing in the Chinese market, and to just get a feeling of how things work with the tax officers and how things work with the tax bureaus. Now, the tax officers are just the general entry in terms of the hierarchy of that tax district bureau. The tax officer, the normal meeting lasts maybe half an hour. You've kind of discussed the transactions, the business, why you've come to China, and he will just reiterate to you what tax obligations you're going to have, what deadlines he expects to receive from you, etc., etc. Very standard meeting. You may come back and then you might say, okay, well, at this point I need to apply for general VAT taxpayer status. I may need to apply for tax refunds or tax exemptions, and I want to get these applications up and running as soon as possible. So you're going to then have a second meeting with him saying, I want to apply for all of these various items. What criteria do I need to surpass? What documentation do you need from me? This is all critical because you want to have open communication with your tax officer. You want to have open discussions. You want him to be involved. He's not your enemy. The enemy only reveals itself when you actually want to get tax deductions, etc. That's when the real negotiations come into play. So it is important to have this open dialogue. Now, when you are applying for tax exemptions or tax deductions, the tax officer, his responsibility is to make your life difficult. He's going to review every single aspect of every application document you're submitting. And if you haven't reached a certain criteria, he will say no. Now, does that mean you should just give up the fight? No. He has a superior who has another superior, and you can go up the ladder and say, I want a meeting with your superior to discuss my case. You just need to choose and evaluate on what fights you should fight for and what fights you should just say, okay, that is not important to me, I quit now. Our experiences have been that if you fight every single fight, you're going to make an enemy of the tax officer. And he's going to fight with you on everything because you haven't given any type of leeway with him. So you really do need to evaluate what do you need to fight for and what should you just say, okay, he wins. You need to make balance in the relationship. He wins some, you win some, he loses some, you lose some. It's a balance, and it helps develop the guanxi, the relationship, the strong relationship with your tax officer. These are critical points. Now, as you move up the ladder, obviously you're going to get, the tax officer will become more and more embarrassed because it will seem to his superiors that he cannot handle the case. This is also why you don't want these individuals to lose face in regards to these applications. So again, you should really evaluate what you want to fight for. Now, the tax authorities, again, they're very straightforward. If you don't reach the criteria, then really, and they've told you you don't reach the criteria, then in reality you need to give up the fight. There's no pushing further. Even if you've gone up the ladder and at every step of the ladder they've said, no, you don't reach the criteria, then full stop, you don't reach the criteria and you can't move forward. And at some point you will have to give up the fight. So the tax authorities, you know, it's all really common sense, but it is a matter of developing the relationships, having an open dialogue, and developing a guanxi with them. And as mentioned, your outsourced provider will develop that relationship on your behalf, but we do, and I speak for most corporate service providers, we do enjoy if you come with us so you see for yourself what it is like to go to your tax bureau, what it looks like to meet your tax officer, what type of character is he, and sit in front of him. It helps a lot with discussions and dialogue. If you have your own in-house accountant, in order to help her or him, you should also be attending the tax bureau so you understand the dilemmas that he or she is facing when negotiating with the tax bureaus. Now, I think the main part of today's session and webinar is really looking at the various taxes that a company is liable for and understanding how those are calculated. So before going into all the different types of corporate taxes, I do want to go through the individual income tax in China and for you to understand what needs to be paid. Now, for anyone that's residing in China, has a work permit, has a residence visa, automatically they're liable to declare personal income tax, and this needs to be done on a monthly basis. Most companies, they will handle the deductions of the individual income tax and also the social insurance, but we won't be touching on social insurance today. And we'll just be remitting the net salary to the individuals. I've listed here the calculations, which by all means you can look at as you receive the presentation at a later stage. It's not complicated. What does get into complications is understanding who is subjected to pay Chinese tax. As I mentioned, the most obvious is anyone who has a work permit and has a residence visa, they're obligated to pay income tax in China. It's like that anywhere else in the world. But obviously, there are certain individuals that reside in China and don't have work permits and residence visas. And I've outlined here on this table those types of individuals. And really, you need to then focus on the quantity of time they're spending in China and whether taxes then have to be declared, regardless of work permit or residence visa. So if you're in China for less than 183 days, in theory, and when I say less than 183 days, I mean 183 days in a fiscal year, so January to December, then you have no obligation to pay income tax in China. The minute you are over that threshold of that 183 days, you are obligated to pay. And the most frequent question that I then obtain is, well, you know, my staff, we're predicting he's going to be there for less than 6 months. We don't know yet. We will only know that at a later stage. The minute that you know this individual is going to be there for more than 183 days, that's really the moment that you need to be honest, transparent, and start declaring taxes in China for that individual. Now, if there is a double taxation treaty, then in theory, the taxes that they are subject to pay in China can be deducted from the taxes that are paid in the home jurisdiction. The last point I want to make from this slide is individuals that are residing in China for more than 5 years, because this is becoming more and more frequent, where there are individuals that enjoy China, are doing a great job in China, want to stay in China, and potentially want to move from expatriate contracts into local contracts. Now, if you are residing in China for more than 5 years, then by law you are required to declare your worldwide income in China and pay taxes on that. However, you have the ability to break your tax residency. To break your tax residency, you have to do one of two things. Leave China for 30 straight days, or leave China for a total of 90 days within a calendar year. Now, I have come across many tax officers who, although you have the option of choosing one or the other, will say you should have done both. And again, what's the reasoning behind that is because they want to increase their tax revenue. So obviously, although it's not convenient for many, my recommendation would be to try to fulfill both criteria so that you don't run into these greedy tax officers who say you should have done both or you should have done one over another, because ultimately they are the decision makers. And even if you go up the hierarchy, they may also say, we agree with the tax officer. But if you fulfill both criteria, then in theory, there's no reason a tax officer will say your tax residency hasn't been broken up. So again, keep these in mind, especially for those foreigners that have been residing in China. When do you need to do that? Well, you can do that at any point. If the individual has been there for 3 years, he can break his tax residency at that point and start fresh the following year. Ultimately, if he's been there for 5 years and he's not done that, then in the 5th year, he really should be fulfilling one of those criteria, if not both. Obviously, with any package, whether it's an expatriate package or a local package, allowances can be provided to the individuals and they can be non-taxable, they can be deductible. The key is understanding the following. 1, allowances should be specified in the employment contracts if they should be deducted. Tax officers need to approve these allowances. So the key point here is knowing that the tax bureaus have to approve it. Otherwise, deductions cannot be made. And if you've been doing deductions automatically, be careful because it can reflect back at the end of the year when there's the audit and the auditor asks where is the approval from the tax bureau saying that these deductions are permitted. So it is important to know what deductions are available, both for foreigners as well as for local individuals. And you've also got to make sure that all fapiaos, which are the official invoices and receipts, are provided matching those allowances. If fapiaos or these official receipts are not provided, then deductions cannot be made. So again, important tips that have to be controlled and monitored internally to make sure they're happening. Now, before we get into taxes for LLCs, I think it's important for everybody to be aware of if they're in that stage of not knowing whether to establish a representative office or an LLC, to understand what taxes are applicable to a representative office. And here I've outlined very clearly for everybody to see all the formulas and calculations in regards to the taxes that have to be paid by a rep office. Your first question may be, well, a representative office, from what I've understood, is a liaison office. It's a cost center. Why does it have to pay taxes? That's ridiculous. Well, the Chinese Tax Bureau says if you have a representative office in China, then in some shape or form you are doing business in China, and your parent company is earning revenue off of the work that's occurring in China. As such, some type of tax needs to be paid on that deemed revenue. So these formulas are basically calculating the deemed revenue and then providing a percentage rate on what needs to be paid and declared. Generally speaking, as a rule of thumb, you're looking at between 10 to 15% of taxes based on the costs that you're incurring in that representative office. Now, what costs need to be included? Salaries of every individual that is residing in that entity needs to be included. Rental for the office, communication costs of the office, fixed assets in terms of furniture, computers, etc. Maybe you've also purchased a car for the chief representative. So any types of fixed assets need to be included. In addition to that, any type of travel costs should be included as well. Now, people always try to be smart, and they try to say, okay, you know, I have 3 foreigners that are based in the representative office. I'm going to try and put all their travel costs and expenses underneath the parent company so that we don't incur such high costs and we don't pay such high taxes. Be careful with these type of tricky situations. Questions will arise. If you have a good auditor, again, should arise from the auditor. And 2, the tax bureau may question it as well. Especially if they start asking to see the passport copies of the foreigners and saying, wow, they've done so many trips, where are their expenses? Which can happen. You just need a tax officer or an auditor to be thorough with their work and to ask these types of questions. So be careful. Obviously, the basic costs have to be included no matter what. They can't be paid directly from your parent company. So be aware of all of this. So let's go on to the nitty-gritty in terms of taxes for LLCs, and that's really where the main part of my presentation lies. There are a lot of taxes that need to be considered depending on the industry that you're in, the transactions that are occurring within your entity. The primary tax is obviously the enterprise income tax, otherwise known as the profits tax. Now, since 2008, I believe, there is a unified standard tax rate in China of 25%, no matter where you are located. Now, you can apply for tax reductions, which can be up to 15% if you are in a new high-tech enterprise or if you fulfill other types of criteria really focused on the 5-year plan of China. So in the industries that the 5-year plan is focused on, usually those industries get exemptions with the enterprise income tax. And you also get tax holidays. The application for applying for these tax reductions and fulfilling the criteria for them is difficult. If you are a startup, I can tell you now, you won't fulfill the criteria. Because if you just have one person on staff, it won't work. You have to make sure you read through these criteria in detail. You have to understand what is the application procedure. You may even want to have a representative from the company, which we always recommend, join in these tax negotiations to show how serious you consider the application for these tax reductions or tax holidays to be. Preferably someone in the finance department, in order to be able to benefit. Now the issue is, once you've received these qualifications, you may have to go through renewal procedures on a year-to-year basis to make sure that the criteria that you have already gained, you haven't changed those criteria throughout that year. And the criteria still match in the following year. So renewal processes may be requested by your tax officers to make sure no change has occurred within your entity. These are all very critical applications, very difficult to obtain, and guarantees are never there. That's the issue in China. You may believe that you fulfill all criteria. You may have tried to convince them in the tax office, in the tax meetings and the tax negotiations, but in the end of the day, it's their decision. And unfortunately, no guarantees can ever be made. That's what nobody wants to hear, obviously, but that is just how the Chinese system works. Now, if you haven't established an entity in China, there's always a key issue that arises in terms of permanent establishment. And I want to focus on that a little bit today as well. Permanent establishment is primarily focused on companies that are non-resident enterprises in China, meaning they have no physical establishment, but they are pursuing projects and having staff that are based in China. If you do fulfill the permanent establishment rule, then enterprise income tax needs to be declared in China based on the projects that you're handling in the local market. So you need to be aware whether you fulfill those permanent establishment criteria or not. Permanent establishment is a clause within all double taxation agreements. So you should be aware in the double taxation agreement between China and your home jurisdiction what the rules say about permanent establishment, time frame for projects in order to accomplish that permanent establishment rule, etc., and be aware of them. That's really how you're going to optimize your whole system and your whole flow. And if you do reach permanent establishment, then a key consideration for you would be, do I now establish an entity in China or not? Because I've anyway got permanent establishment based on China's regulations. Transfer pricing for multinationals has always been an issue in China, but it is now becoming more and more of an issue for small, medium-sized companies. Transfer pricing really relates primarily to transactions that are occurring with related parties. So, for example, funds being transferred from China to the parent company, funds being transferred from the parent company to the China entity, or any other sister companies that are within the group. You need to be aware of market values. You need to be aware of customs procedures in relation to transfer pricing. And you need to be aware of what documentation needs to be prepared and what thresholds are for you to be able to prepare those documentations for submission to the various tax bureaus. If the tax bureau calls upon you and says they want to see the transfer pricing documentation, you should have that readily available in your desk of drawers so that you can submit it, because usually the time frame once you've been asked to submit is 20 to 25 working days. If you cannot reach that deadline, then the tax bureaus will normally request a penalty to be paid. Now, as I mentioned in my previous webinars, penalties in China are not necessarily high, but the issue is you haven't reached the deadline. You're now going to be more scrutinized by the tax authorities in relation to all related party transactions. You don't have to have the documentation readily available if your revenue levels, and it also depends on industry and sector, are under 20 million renminbi, or in some cases 40 million renminbi. So again, startups, not something you really need to concern yourself with right now, but as your transactions are increasing, as your business is developing, then you should start considering having transfer pricing documentation available. One of the biggest questions I get for companies that have reached the thresholds and must prepare the transfer pricing documentation is this market price evaluation that needs to occur based on the products that you are selling. And the issue obviously is that, you know, how reliable are the figures that can be obtained in China? And that's a question mark that everybody has. I have had cases where companies have used providers to do these types of evaluations, and different reports have been issued. So that is a tricky subject when it comes to transfer pricing. The next subject is looking at withholding tax. And withholding taxes, this is a tax that is applicable on non-resident enterprises. So companies that are not established in China. So it relates to dividend transfers, it relates to royalty incomes, interest incomes, rental incomes, transfer of assets, etc. The withholding tax rate in China is 20%, and it can be reduced based on the applicable tax treaties that exist. Usually the reduced rate is at 10%, but for some countries it's even 5%, others 7%. So again, it is important when you're evaluating cross-border transactions with non-resident enterprises, what are the applicable withholding tax rates? Tax treaties, there are 99 tax treaties signed with China. What is interesting is that most tax treaties with Europe have been renegotiated and updated. Some are pending ratification. For me, what's been most interesting with most European double taxation agreements is that historically the China-Hong Kong double taxation agreement was the best. And this is why historically most companies established Hong Kong holding companies for their China investments. With these new European double taxation agreements, the rates that are applicable are the same as the ones with the Hong Kong-China DTA, which is why we see fewer and fewer companies setting up holding companies in Hong Kong and more doing the business direct from their home jurisdictions. So it is critical for your tax optimization structure to know what your double taxation agreement says and how you should structure cross-border transactions. Now, one of the mistakes that I see with my clients is that they don't consider cross-border transactions initially because they are a startup. When you are a startup, you're just trying to build your business. You are trying to sell your products. You're not worried about your profit line just yet. That might come in 2 to 3 years, or in some cases, it might come suddenly if you bid for projects and you win them, and all of a sudden you have an influx of cash and you want to start repatriating funds. Developing a repatriation strategy is something you should think about prior to establishing your entity in China, in theory. I mean, that would be the best objective. If you're already established in China, it doesn't hurt to start looking at these repatriation strategies and what needs to be implemented in terms of agreements, in terms of internal discussions that have to be made with the home jurisdiction and your Chinese entity. But cross-border transactions are important. They do happen, and they happen more often than you expect them to happen. And it's all part, again, of your structure, optimizing your structure and thinking in the long term how you should develop your business and how you should structure your business. Now, VAT is actually one of the hottest topics in China. Value-added tax is basically a type of sales tax in China. And to give you a bit of background on it, value-added tax on the sale of goods is at 17%, and value-added tax on the sale of services is usually at the rate of 6%. For certain industries, it can be lower, and for certain other industries, it can be slightly higher. The key point when you're talking about value-added tax is understanding VAT invoices, VAT fapiaos. And the key here is understanding how the VAT invoice system works. So value-added tax is something that everybody needs to apply for. You would become a general VAT taxpayer. And at that point, once you become this general VAT taxpayer, you need to start buying VAT invoices. With any transaction, you're going to be issuing a VAT invoice. The key is understanding that when you are a startup and you are new to the market, you have done very few transactions, the tax bureau wants to see your commitment to the market, and they want to see that the number of transactions is increasing. So initially, they are only going to provide you with a booklet of between 25 and 50 sheets of VAT invoices where each sheet is worth 10,000 renminbi. If you have consecutive periods of high transactions, you can move up a level where each VAT invoice or fapiao sheet is worth 100,000 renminbi. In case you have deals that are extremely large, 500,000 renminbi or above, then you can also make applications with the tax bureau that they issue an invoice on your behalf with that full total amount. Now, VAT invoices, it's a very tricky subject, and if you do have questions associated around that, then I would be happy to discuss it with you. I have a photo for you to show you what a VAT invoice looks like, and as you can see, it is in Chinese language. A critical point with VAT invoices is the following. Not only do you have to buy the booklets from the tax bureau, but you also have to buy the VAT software system and printer from the tax bureau as well. The VAT software system is basically tracking all types of transactions that are running through the company, whether they are service related or whether they are goods related. And this VAT software system ultimately calculates your VAT liability at the end of each month. You then have to print out VAT invoices that are then given to your customers in China, and this is what the VAT invoice looks like, just for your reference. There are surtaxes on VAT, primarily city construction tax and education tax. These taxes are relatively minor depending on the value of the transaction that is occurring. When companies create their budgets, many of them forget to add the surtaxes that are applicable on transactions, and we've seen cases where budgets are actually completely fuddled up because this hasn't been calculated within. As I mentioned earlier, there is VAT on modern services. It is a relatively new regime, basically since 2013. And here I've highlighted how companies have gone from the business tax regime to the value-added tax regime. And as I said, most businesses in modern services are at 6%. Companies that are in the logistics sector are at 11%. So no matter what business you're in, you are going to be applicable to the VAT system. There are 4 additional industries which will be going through a VAT reform this year, primarily in the telecommunications sector, as well as 3 others. And it's just important to know in these industries that this will be a reform that's occurring this year. Now, what is interesting is that there is VAT on the export of modern services. So what does that actually mean? It means that a company overseas is, or let me rephrase that. There's a company in China that is offering services to a company that is based overseas. On those invoices that the Chinese company is issuing to that overseas entity, VAT exemption or VAT refunds can be applied for. The issue is, and we've had this experience personally, obtaining these VAT exemptions and VAT refunds, it requires very strict criteria to be fulfilled. And you need to be aware of what criteria is needed. And again, this requires an open dialogue with your tax officer to understand what documents do they need, what needs to be written in those documents, which is a critical point, in order to get these exemptions or these refunds. So be aware, if you are a China-based company and you are offering services overseas, whether it's to your parent company or customers, you can apply for VAT exemptions and VAT refunds. VAT invoicing options. This is something that I find quite critical, and it's something that people can't really get their head around. At what point do you give a VAT invoice to a customer? Now, in the Western world, you normally have a regular invoice that's been created in Excel or created in Word, and you give that to your customer. And usually you can file that document inside your accounts. In China, it's a little bit different. You have several options available to you. The first option is obviously issuing the VAT invoice immediately and giving it to the Chinese customer. You're then waiting for the Chinese customer to pay that invoice. You might have 30-day terms, 90-day terms, 180-day terms. You may never get paid. And what is the dilemma at that point? The dilemma at that point is that once that VAT invoice has been issued, you are declaring VAT and paying it, which means there's an imbalance on your cash flow. And if you are in a startup phase, your cash flow is critical to your business. So you may want in your startup phase to develop another type of system where you issue a pro forma invoice, which is basically that invoice in Excel or that invoice in Word that is then given to your Chinese customer. They then pay you based on the terms that you've agreed upon, and upon payment, you issue the VAT invoice, and upon issuance of the VAT invoice, you then declare the VAT taxes applicable on those transactions. In your startup phase, this is quite a critical issue. And if you haven't made a cash flow analysis and you haven't based it on what your VAT invoicing options are, this is really important and something you need to decide upon how to do it. Now, you will find that Chinese customers, depending on the size that they are, will say, no, I won't do business with you unless I have the VAT invoice up front. Other Chinese customers will say, you know, it's no problem, give us the VAT invoice upon payment. We have no issues with that. It's a negotiation, but you should have that negotiation before you start doing any type of business with your customer. And you should understand what the workflow will then be with your customer. What is critical, and this is associated then to the bookkeeping of your accounts, what is critical is that whenever a VAT invoice has been issued or obtained from a supplier, that you book it in the month that it's been issued in. If you start booking things delayed, it causes critical issues with the tax bureau as well as with your auditor. So you need to be aware of that. Now, there are quite a few considerations that a company needs to decide upon in relation to VAT. And I've listed here quite a few questions to raise your thoughts on how you want to handle the VAT issue in China. The first is, is it better for you to be a small-scale taxpayer or is it better for you to be a general VAT taxpayer? From Kohler Group's perspective, as companies are growing in China and some grow suddenly and unexpectedly, others it takes a little bit more time, it's always good from day one to become a general VAT taxpayer because you don't want to lose out on bids where the customer is requiring you to be able to issue a VAT invoice with 17%. Small-scale taxpayers have different regulations in terms of VAT. And it is a reason why we always try to recommend and push our clients to go the general VAT taxpayer route. You need to understand what is the applicable VAT rate depending on the transactions that you're doing. Are you transacting with goods? Are you transacting with services? And what is the rate that is then applicable? And how is the filing method? You need to classify the service. Now, especially in the logistics sector, depending if you're freight forwarding or you're actually doing shipments, there it's critical to classify the service that you're doing. Otherwise, for most other service industries, the rate is at 6% if you are a general VAT taxpayer, or it's 3% if you're a small-scale taxpayer. Is the input credit available for my company? Now, this is a critical question, primarily for startup companies that are initializing their first transactions. If you don't have the general VAT taxpayer status yet, don't start transacting. Otherwise, when you purchase goods, you won't be able to deduct the VAT that you paid on the purchase of those goods if you don't have the general VAT taxpayer status yet. So be aware of that. That's very critical for those people that are in startup phases. Can you pass on the VAT cost to your customer? Yes, you can. In theory, the VAT invoice includes the service fee plus the VAT and surtax amount. And the implication for cross-border transactions, again, critical. If you are a Chinese entity and you're providing services to companies that are located overseas, you need to be aware of what taxes are applicable and whether you can obtain VAT exemptions and VAT refunds. Now, from a structural and operational perspective, you need to understand what is the system that you're going to be utilizing. How are you going to capture different types of income, whether trade or service? You have to understand workflows, business flows, cash flows, trade flows, good flows, etc. You need to understand how you're going to issue the VAT invoices. Are you going to issue it up front, or are you going to issue first a pro forma invoice? There's no right or wrong answer with that. That depends on your negotiations with your customers. It depends on how you want to start your internal your startup phase, and it depends on how critical your cash flow is. And then the last point is, if you're going to establish branch entities, Are they going to be operational or non-operational? If they're non-operational, then there's no issue. If they are operational, then it means that the operational entity is actually going to be invoicing. And at that point, they need to have also the application to issue VAT invoices. They need to have the VAT software system input, and they also need the VAT printer. So you need to be aware how, if you are expanding in the market, how are you going to handle that from a structural and operational perspective. Now, my last two slides have really kind of summarized all the remaining taxes that are applicable in China. Everything from consumption tax to land appreciation tax, resource tax, real estate tax. For me on this slide, the most critical is the consumption tax, because if you are importing or dealing with luxury products, then you are going to be dealing with consumption tax as well. And you need to understand what the rates are. The rates are different depending on the types of products that you're dealing with. So again, consumption tax, one of the critical ones. Real estate tax and land appreciation tax, this is really only applicable if you have purchased land or you've purchased the office that you're going to be located in. Those two taxes would then be applicable. On the next slide, you're looking at customs duties, vehicle and vessel tax, motor vehicle acquisition tax, stamp tax, and deed tax. For me on this slide, the two critical items are the customs duties. And again, this is where you need to know if you're importing goods into China, what is the related customs duty rate. You also need to be aware of stamp tax. For any type of agreement that is signed in China, whether it's your lease agreement, whether it's supplier contracts, customer contracts, there is a stamp tax that is applicable and paid at the end of the year based on all the contracts that you've accumulated and signed, which is why it is important, as I mentioned in yesterday's webinar in terms of corporate compliance, to make sure that all contracts are up to date and have been renewed and are valid so that the stamp tax can then be applicable. Finally, I just want to go through the annual compliance procedures. We will be having a webinar that our last webinar for next week will be based on annual compliance procedures and the processes. But in relation to the accounting and tax system, it's obviously a critical component. You do have annual audit requirements that need to be fulfilled. You do have annual individual income tax filings, annual profits tax filings, and then from a corporate compliance perspective, legal compliance perspective, you do have annual inspections and business license registration certificate renewals as well. So you need to be aware of these annual compliance procedures. So Barbara, that's the end of today's presentation. I hope I was able to provide everybody with an overview of the accounting and tax system in China.
Okay, thank you so far, Christina. There are a series of questions that have come in during your presentations. Let's start with the first one. We're looking for an optimized tax structure once we completed the registration of our LLC with our branches. How can we go about doing this?
So as I mentioned during the presentation, optimized tax structures should really be something you're thinking about prior to implementing your entity and implementing your structure. Primarily because it relates to where is your holding jurisdiction for that investment, and it relates also to then the internal operations in China with your main LLC and then the various branch offices and whether they should be operational or non-operational. Creating optimized tax structures, I mean, the first thing that I would recommend you to do is have a face-to-face meeting with a tax advisor. You need to be able to explain very clearly what are your objectives in China, what structures are you looking to develop in China, so that a tax optimized structure can be then formulated based on what you're doing. Tax optimizations are very case-by-case oriented. We, as we are tax advisors, we need to know what the home jurisdiction is. We need to know what you're trying to develop locally. We need to understand what transactions are being planned both in the short and the long term to really then create this plan.
Okay, there was another question coming in. What are potential tax and VAT pitfalls for overseas companies with contracts with Chinese companies, for example, architecture services?
So this is where I was relating to the VAT exemption and VAT refund slide. So if you are formulating contracts with Chinese companies and these Chinese companies are providing services, or you're providing services to these Chinese companies, you should talk to a Chinese tax advisor, first of all, locally in China, and then you should also talk to your home jurisdiction tax advisor, because with all of these double taxation agreements that are running back and forth, you want to know what are your tax implications in both jurisdictions. So it is important to talk to people in both locations, and obviously it helps to do that during the period where you're negotiating with your Chinese customer or your Chinese supplier in terms of offering these types of services, whether it's architectural services, marketing services, logistics services, freight forwarding services, etc. So really that has to be done in that period of negotiating the contract and making sure you're aware of all the taxes that are applicable. What we have seen in the market is that people in China, they don't necessarily know what is applicable, and as a consequence to that, they have a lot of issues in the negotiations, and there's a lot of confusion between both parties.
Okay, so this is already the last question. What important tips can you offer to prevent accounting fraud and to keep control of the books and taxes being declared?
Oh, that's a very tricky question. I think that the key point here is making sure that the finance team in the home jurisdiction reviews the accounts that are done monthly, and if they have any questions or issues, to really talk about them up front at the time that they occur, so that fraud can be evaluated and reviewed. The other issue is you need to develop with your team in China monitoring systems and control systems and documentation flows so that you have reviews of all of these documents. That would be one of the key components to making sure that fraud doesn't exist. And obviously another component is then traveling out to China. That's one of the biggest tips that I would have, is going to your offices, doing internal audits, doing internal reviews, providing health checks to see really that you are compliant, that there are no fraud tips that are occurring, and you might even want a third party or a new set of eyes going on those books and coming into the Chinese entity, just so you can get an external opinion that everything is fine.
All right, thank you, Christina. Unfortunately, we do not have enough time to answer all of your questions. But in case you have further questions or want to talk about your individual cases, please contact Christina privately after the webinar. Here on this slide, you can see her contact details. You will be receiving a copy of this presentation together with Christina's contact information. We hope that you enjoyed this webinar session. We just want to remind you of all our upcoming webinar sessions in this series. If you're interested, please register for the webinars on our website. The recording of this webinar will be posted on our YouTube channel and distributed on our social media sites such as LinkedIn, Xing, and Twitter. In addition, if you're interested in our weekly e-campaign highlighting all the latest resources we publish, do not hesitate to subscribe. It is free of charge and can be easily done on our homepage by inserting your email address into the section called ChinaInvest.biz. Thank you, Christina, for presenting to all the attendees and registrants. Thank you also to all for joining us today. We look forward to seeing you again soon. Have a pleasant evening and goodbye.